Congratulations, you've made the decision to sell your business. Now it's time to start working the plan and getting your business ready to sell. Let's get into it. First, if you want to maximize the full value of your business, look after your key employees and make sure that your clients are properly transitioned to a new owner. This will take some time. How long? It can take months or maybe even years, depending on your business. If you believe you can sell your business and leave within a few months, I would suggest that you take a deep breath and continue watching. A word of caution before we begin. It may not be in your best interest to inform all of your employees of your intentions to sell until much later. They may become alarmed and wonder if their jobs will be in jeopardy, and they could begin looking for alternate employment, so please do be careful. One of the first things you must do is get your business ready to sell. This means reviewing and organizing your financial statements, reviewing your business practices and deciding what to keep and what to drop, thinking about an ideal buyer profile, getting your business ready for that important first impression with a prospective buyer, and thinking about what financial terms and conditions you'll be prepared to accept or not accept. Let's start with getting the physical and visual stuff ready in your business. If you've ever sold a house, the first step in selling before it's listed for sale is to properly stage the property to make sure that it looks absolutely at its best. Same thing applies to your business. Let's start with the visual part first. Get rid of old and tired looking office furniture, add a fresh coat of paint, throw out old and out of date marketing materials, clean up the main entrance, and make the business look more professional. When is the last time you reviewed your website or your business stationery or other materials? Clean everything up and correct any typos or incorrect information wherever you might find them. You know what? While this might sound insignificant to you, in the buyer's eyes, it's an indication of how well or how poorly you've run your company. About your financial statements, are they accurate and up to date? If not, speak to your accountant and get these in order. A buyer will typically ask for the last 3 years of financial statements, so get these in order. As well, be prepared to answer questions about your financials. Why was the profit lower, say, in year 1 as compared to year 2? You'll want to be prepared to discuss any personal expenses that you've been running through the business so that a buyer can understand which expenses will stay and which expenses will disappear, such as vehicle expenses, travel, etc. Let's talk about what to keep and what to drop. Now, this is a broad subject that can include which business practices to keep or discontinue. In other words, let's say that you have a product or service that isn't performing well. This is a good time to drop it and potentially decrease your expenses at the same time. This also applies to dropping your worst clients. Fire your problem clients rather than trying to sell them as part of the transaction. You will be disappointed if you try to do that. You know, have you ever heard of the phrase PITA clients? That's P-I-T-A. If not, it stands for pain in the blank clients. Everyone has them and everyone should get rid of them. These are the clients that call and complain to you and your staff. These are the clients that are never happy and can never be pleased. And these are also the clients that run the biggest risk of suing you or filing complaints about you. Now, be super careful about how you fire these PITA clients, but believe me, you and your staff will be so much more happier. Let's talk about how and what to communicate to your staff. It will be difficult to fully implement your exit plan without the help of some or all of your key employees. So I would suggest that you inform your key employees of your intention to sell the company. They will be concerned about their employment status after the sale, so you'll want to give serious thought to how you will answer those questions. As an example, some of your key employees might be nearing retirement and might decide to retire after the sale is done, while others may really rely on that job to continue. Ideally, a new owner will want to retain some or all of your key employees, and they should understand that employee retention will be important for client retention. If you're found in the position that the buyer does not want every employee to move over, the topic of termination with severance and benefits will have to be considered. So you'll need to be prepared to think about and use some of the sales proceeds toward paying some employees a severance pay. Once again, speak to an accountant for more details on this. Depending on the type of business that you're in, and if you're part of a larger organization, say a financial advisory firm, accounting or law firm, etc., where you can sell your book of business, you'll want to communicate your intentions to sell with your head office. Your head office may be able to recommend some potential buyers in-house and may have some attractive financing options that a new buyer can take advantage of. Most importantly, your head office will be motivated to keep your business within the firm and will help you transition into retirement. You'll want to consider thinking about an ideal buyer profile as well. In other words, you'll want to make sure that the new owner can offer the exact same products or services that you currently offer. Again, as an example, let's say you're an accountant and you've offered income tax preparation to your clients for many, many years, and this is an important service that your clients rely on you to provide. If the new owner cannot or will not offer these services to your clients, you'll have a disaster on your hands. Your clients will be upset and will ultimately leave to join another accounting firm. When this happens, your client retention clauses will kick in and it will reduce your overall business valuation. So in other words, you as a seller loses big time. So make sure that the new owner will offer the same services that you have. Let's talk about the financial terms that you're prepared to accept or not accept. And let's start off with the most important terms first. Will you be asking the buyer to purchase assets of your firm, or will you want them to buy the shares of your corporation? This is a huge consideration for both parties. I would suggest that you watch my episode called Buying or Selling the Business, Asset Purchase versus Share Purchase, and this will give you the full insights on the significant differences between these two options. You know what? That's enough for today. Please stay tuned for future episodes where I can provide some interesting business valuation ideas and unique payment terms that will help you to realize the full value of your business. Thank you for watching. If you've enjoyed this video, please subscribe for future updates and give me a like. In the meantime, think long term.